Welcome to our deep dive on debt relief programs and the reality behind them. In this video, we'll unpack how debt settlement actually works, the hidden costs many people are not told about, and the better, safer alternatives that can help you escape the burden for good. We'll also talk about how to fix the root causes so you don't end up back in the same spot. Let's begin with a clear agenda so you know exactly what's coming. Here's the plan. First, we'll look at what debt settlement claims and what it really does. Next, we'll quantify the hidden costs, including credit damage, collections pressure, lawsuit risk, and IRS implications. Then, we'll compare DIY settlement versus hiring a settlement company. After that, we'll explore better alternatives, like debt management plans through nonprofit credit counseling and, if necessary, bankruptcy options for a cleaner reset. Finally, we'll close with an action plan and how to correct financial behaviors to prevent recurrence. Let's set the stage with the harsh truth. Debt settlement programs usually instruct you to stop paying your creditors. This intentional delinquency pushes your accounts into default, and that default status is then used as leverage to negotiate a lower payoff. While this may reduce the amount you owe, it often causes severe and immediate credit score damage, aggressive collection activity, and the risk of lawsuits. To understand why this matters, let's map the process end to end. Here's the step-by-step. You enroll with a settlement firm that directs you to stop paying creditors. You then build a savings fund for a future lump sum settlement while accounts become delinquent. During this time, late fees and interest accumulate. Creditors may send your accounts to collections, triggering calls, letters, and intensifying pressure. Eventually, the firm negotiates a reduced payoff, which you pay from that fund, often alongside a substantial fee to the firm. The account is then reported as settled for less than the full balance, which is negative on your credit reports. Additionally, any forgiven amount above $600 is generally considered taxable income by the IRS, which can result in a tax bill. This is the real mechanism behind settlement. Next, let's test your understanding. Question: what is the primary tactic debt settlement firms use to gain negotiation leverage? Options: A. Raising your credit score first. B. Continuing minimum payments consistently. C. Stopping payments to push accounts into default. D. Opening new credit lines to consolidate debt. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Stopping payments to push accounts into default. This tactic creates leverage for negotiation, but initiates severe credit damage and heightened collection activity, which carries additional risks. Let's unpack the hidden costs. First is credit damage, often a drop well over 100 points. Next is the collection pressure from calls and letters, and in some cases litigation that could lead to judgments and wage garnishment depending on your jurisdiction. There's also the tax factor, since forgiven debt above $600 is generally taxable income and may result in a 1099-C. Settlement firms usually charge significant fees, either as a percentage of enrolled debt or as monthly program fees. Finally, the process can take 2 to 4 years, extending stress and uncertainty. Now, some people consider doing this without a firm, so let's compare DIY to hiring a company. DIY settlement can save you the significant fees charged by settlement companies and gives you more control over your process and timing. However, it does not eliminate the core harms. Your credit still suffers, collection pressure continues, and lawsuits remain possible. Using a settlement firm delegates the negotiation, but introduces substantial fees and does not remove the inherent risks. Additionally, some creditors refuse to negotiate or offer only modest reductions, making outcomes uncertain either way. Given these drawbacks, it's crucial to consider alternatives that reduce harm and improve the odds of lasting success. Next, we'll explore better options. Here's a decision flow. If you can realistically repay the full amount with reduced interest, a debt management plan via a nonprofit credit counseling agency consolidates payments and lowers APRs, letting you pay in full without the credit devastation or tax issues of settlement. If repayment is not feasible, check eligibility for bankruptcy. Bankruptcy provides immediate legal protection via the automatic stay, halting collections and lawsuits. Chapter 7 typically concludes within several months and discharges eligible unsecured debts. Chapter 13 creates a court-supervised repayment plan over 3 to 5 years. If you're not eligible or not ready, focus on deep budget cuts and increasing income, then reassess after 2 to 3 months. Next, let's visualize where your money goes before and after a DMP. When your interest rate is high, A large share of each minimum payment goes to interest rather than principal. In many cases, a majority of the payment is interest, which means your principal balance barely moves and the debt persists for a long time. This explains why many people feel stuck, despite making payments every month. Now, let's contrast this with a DMP scenario. Under a debt management plan, reduced interest rates shift more of your monthly payment to principal. As a result, the balance declines faster, and you avoid the tax consequences associated with forgiven debt because you are repaying the full principal. While accounts are often closed under DMPs, the overall credit impact is typically far less damaging than settlement and improves as balances decline. To help you act, here's a practical starting plan. To explore a DMP through a nonprofit, first inventory all unsecured debts with APRs, minimums, and balances. Next, find accredited agencies, for example through the National Foundation for Credit Counseling. Schedule a free counseling session to evaluate your options. Request estimates for new interest rates, combined monthly payment, payoff timeline, and any modest setup or monthly fees. Verify which creditors will participate and whether accounts must be closed. Make sure you receive written documentation of the program terms. Once enrolled, automate payments and monitor progress monthly to ensure balances are falling as expected. Now, what if your debt is simply unpayable? Let's look at bankruptcy basics. Bankruptcy triggers an automatic stay, which immediately stops most collection actions, including calls, lawsuits, and wage garnishments. In Chapter 7, qualifying unsecured debts can be discharged in a matter of months, offering a relatively rapid reset. In Chapter 13, you commit to a structured repayment plan over 3 to 5 years, after which remaining eligible debts are discharged. Although the credit impact is significant, many people rebuild credit with responsible habits, secured products, and time. Next, to compare all options at a glance, let's use a table. This table compares the major options. Settlement, whether DIY or through a firm, typically causes severe and persistent credit damage, provides no legal protection, and can result in taxable income for forgiven amounts. Debt management plans through nonprofits cause moderate initial credit effects, but usually improve your profile as balances drop, and there is no tax on forgiveness because you repay the principal. Bankruptcy offers immediate legal protection, with Chapter 7 providing a relatively quick discharge and Chapter 13 providing structured repayment. Each option carries different fees and timelines. Weigh them carefully based on your situation. Before moving on, let's check your knowledge. Question: which option provides immediate legal protection that stops most collections and lawsuits? Options: A. Debt settlement. B. DIY settlement. C. Debt management plan. D. Bankruptcy, Chapter 7 or 13. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Bankruptcy, Chapter 7 or 13. The automatic stay halts most collection activity and lawsuits immediately upon filing, which is something settlement and DMPs do not provide. Addressing root causes is essential. Without correcting overspending, irregular bill routines, and lack of buffers, any program risks becoming a temporary bandage. Systems, automations, and accountability structures are far more effective than relying on willpower alone. To make this actionable, here's a checklist you can use immediately. Use a zero-based budget to allocate every dollar. Automate fixed bills and minimum payments to prevent misses. Pick a debt payoff approach. Avalanche prioritizes the highest APR for the lowest total cost, while Snowball focuses on the smallest balance for motivational wins. Build an emergency fund to reduce reliance on credit for surprises. Explore ways to increase income and reduce discretionary spending. Track progress weekly and hold a monthly money review. Systems and consistency will protect your progress more reliably than willpower alone. Now, before we wrap up, here are the key points to remember. The essential points are: settlement relies on not paying, which damages credit by design. Collections pressure, lawsuits, and taxable forgiven debt can add to the cost. DIY settlement can reduce fees but not the fundamental harms. Debt management plans lower interest and consolidate payments, typically without tax implications. Bankruptcy offers legal protection and, in many cases, a faster route to stability if debt is unmanageable. Lasting success depends on correcting the behaviors and systems behind the debt. Disclaimer: This content is for educational purposes only and does not constitute financial, tax, or legal advice. Laws and creditor policies vary by jurisdiction and by individual circumstances. Before making decisions, consult with qualified professionals such as a nonprofit credit counselor, a bankruptcy attorney, or a certified financial planner. Any examples or timelines provided are illustrative and may not reflect your specific situation. With that said, let's summarize and give you next steps. To move forward, fully inventory your debts and cash flow. If repayment is viable with lower interest, talk to a nonprofit credit counseling agency about a DMP. If repayment is not realistic, consult a bankruptcy attorney promptly to understand your rights and options before lawsuits escalate. Regardless of the path, automate payments, track progress, and build protective habits. Ultimately, prioritize long-term freedom and stability over short-term credit score optics. Thanks for watching. If you found this valuable, please like, share, and subscribe. Tell us in the comments what path you're considering or which questions remain, and we'll create follow-up content to help. See you in the next video.